we had the money. We were very conservative, no debt, ready for a rainy day, ready to seize the opportunity, buying our stock back. COVID hits, the pandemic hits, everybody's, our equities in the tank, we're losing momentum. And the first thing that happens in Q1 is it's all kind of shock and awe. And in Q2, the question is, how does this impact my customers, our business, our product, our value proposition? And, and by the way, everybody gets impacted differently, right? If you're running a cruise line or a theater or whatever, and sometimes counterintuitively. And in our case, we sell enterprise software that helps you think better. We sell business intelligence, and we sell business intelligence to lots of governments, agencies. We sell it to massive banks. We sell it to, in essence, global 2,000 companies. Even the ones that get impacted, they're like the national airline. They can't go out of business, right? So that's our customer base. So we realized that our software kept working. Demand was still there. Everything is smooth. And in fact, the great thing about software is software you can ship even, over the internet. All of our services went remote. So our value proposition's intact. And the surprise for us is our productivity went through the roof and our cost structure compressed. All of a sudden, $20 million a year of flying around in airplanes went away, and $10 million worth of trade shows and $20 million worth of marketing things went away, but the customer and demand didn't go away. So we actually found that we were much more efficient. So bottom line is, yeah, we got that black swan event, but that black swan event actually kicked us into a high gear of productivity. And so that was the positive on the P&L side. We realized that we were going to generate more cash, and there was no real rational business plan where I take $200 million and I spend it to make the business better. I can burn it to make but I can't spend it to make the business better. So simultaneously, we got a gift from the Fed and the macroeconomic side. So while we're trying to figure out what happens on the P&L, all of a sudden we see, what do we see? The long bond index goes up 22%. If you had asked me, Anthony, like what's the investment that you do not want to make, I would never in a million years buy a 30-year bond that yielded 2% interest. Never, ever. And yet that was a winner this year. If you bought a 30-year bond at 2% interest, when the interest rates go to 1.2, you've actually got a massive spike. So equity spiked, big tech spiked, bonds spiked, and we looked at our cash, and I had to listen to a litany of talking heads, Ray Dalio on down. If Ray Dalio didn't say cash is trash, every podcaster that trolled Ray Dalio said Ray Dalio says cash is trash. Cash is trash. And then I went to school at some point on you. This is after I realized I had a problem, and I listened to you describe the plight of the working man. I go to work, I get paid okay, this is not a working man, this is a working lawyer. I get paid $500,000 a year. I save $50,000. I put it in my piggy bank. I have $500,000 in cash in the bank. I have kids and I have a future. And then all of a sudden I realized that the cost of a college education is going up at 8% a year, and my cash is yielding zero. Now, at that point, we've got the Pomp podcast telling me I'm crazy to work for dollars and save my cash. And if you take the $500,000 and the plight of the lawyer with the two kids we're going to send them to Harvard and the $500,000 of cash in the bank yielding zero, and now you multiply everything by 1,000. That's me. I have $500 million company. We're making $50 million a year. I got thousands of people working as hard as they can possibly work. We're sacrificing right and left. We're squiring our pennies away. We're putting it into the bank account. There it is. And, in 2019 and before, we worried about the unknowable and we thought maybe we'll use it for something. And by the way, I'm a bit older than you. I remember when you got 5% interest overnight on your money. And it wasn't that long ago that the risk-free interest rate was 5% before the great financial crisis. And I'm like, well, I'm going to make $25-30 million a year on this. And I kept hoping and waiting for those good times to come back. I was the guy that when the interest rates, when the 30-year T-bill interest rates started to go to 3.5%, I'm like, finally they're going to go to 4, and then they're going to go to 5, and they're going to go back to normal, right? Normal interest rates. And then, of course, hope was dashed. It went the other way. And what happens next? Well, asset inflation goes through the roof, right? And, this entire conversation of inflation, it's really twisted because everybody talks about consumer prices, CPI, inflation, that we're not getting enough inflation. We're not getting enough inflation. Okay? Well, you're not getting inflation on YouTube and Netflix streaming videos and candy bars manufactured by robots and factories and Domino's Pizza. You're getting inflation on everything you want. If you wanted an Ivy League education, if you wanted a beachfront house in Miami, if you wanted the apartment in New York, if you wanted anything scarce, everything you want is going up 7%. And that's asset inflation. By the way, if I want a bond that's going to yield $50,000 a year, it used to cost $1 million, and this year it costs $10 million. The cost of the asset went up by 2%. No, I have a house in Miami Beach. It was a nice house built in the 1930s, and I have the deed of sale for the house. $100,000 for that house in 1930. It's gone up in price by a factor of 100.